So pop into the production screen, make sure that your production people are capable of it. So you can see in here, yeah, okay, they are capable. They can do easily with no overtime. Second shift production means overtime. With not even having to do any overtime, they can comfortably get 1188, and that's after losses, because you're going to have some that are just not fit for use. So 1200 production, 1188 for use. So yes, you are safe in saying that you could require them to produce 1,000 units on your forecast, and you would actually be able to fulfill that kind of order because you will be able to make that. So don't set this at 3,000 if you can't make 3,000 without hitting massive overtime. So what if you wanted to say, well, what if I want to go closer to production? You're looking at the production and you're saying, okay, well, production says I can make 1188 without even having to go to overtime, so how about we try and sell 1188? What do I have to do to sell 1188? So then let's go in here and let's say if we wanted to sell, let's say 1188, and recalculate that. What are we anticipating? Well, we're probably going to anticipate that it's very possible to do, because we have the production ability to do it without having to go into overtime costs. And it's really up to you whether or not you think that that's a reachable number or not. I think 1,000 would be very reachable, but if you want to push it to 1188, go for it. I would probably even feel comfortable pushing it higher, but it's totally up to you. Again, go in there, look at your products that sold. Here, again, these were our productions for our products last time. 30%, 33. Atom was the best-selling product. In the high end, only sold 366 units. Okay? And so let's pull up the high-end market, high-end segment analysis. Atom in the high-end segment, it was listed at $38. At 800 promo budget, it was at almost half of accessibility and awareness, and they were priced at $38 per sensor. So can we sell 366 of them again? Well, let's see. What is it saying? 357. And did Atom change price? That would be a good thing to do if you're doing marketing. Well, check R&D. What changed for Atom? Well, Atom went up a little bit in price. Atom is now $16.01 to make, which means it only increased 7 cents. I'm sorry, not 7 cents. Like, we're not doing time here. About 50 cents each. So count that 50 cents in. Make sure that you consider 50 cents in your price here. So bump it up and make sure that it's okay. Check your benchmark predictions. What does the computer automatically figure? 352. Okay. Last time you sold 366 in that same market at $38. Can you sell 366 at $38.50? Probably. So what if you bump this up by $50 more? Okay, your promo budget and your sales budget. Get out more customer awareness. What does it move up to? Well, it's 357. So let's say we wanted to move this to 900. Remember, this is our highest performing product. Okay, so we want to get more awareness. So let's say we decide, you know what, let's go even higher. This is our number one product. Let's push our sales and promo budget 200 over what we had to start with. And now we're at 375. That's just barely more than what we sold last time. So I think that we're comfortable saying that that is totally doable. Now go into production. See what can be produced. Okay? Atom can produce 406 after adjustments. So can we sell 406? I think that that's a perfectly reasonable amount to try and sell. And so let's say we wanted to say 406 here and recalculate. Okay. Now, what I want you to notice is that in this scenario, that would make this product be less performing than Able, because the contribution margin for Atom would now be 5,000 and the contribution margin for Able would be 10. So that means that in performing this way, we're putting more emphasis on Able than on Atom. And that may be a good thing, and it may not be a good thing. If you want to continue to keep Atom as the #1 selling product, then you would want to pump more into getting it to that point. But as far as production goes, I'm going back to the production screen here, we would need to go into overtime in order to produce more than 406 units. And production overtime costs for Atom are $9.39 each, which makes it $1 more expensive than Able and $2 more, almost $2 more expensive than Acre to do that. So going into overtime on any of these three products is extremely expensive. And that means that considering maxing out Atom without going into overtime is your ideal situation. If you're going to go into overtime, do it on the two cheapest products that you have with the cheapest labor. So now let's go back to marketing again, and I'm going to go ahead and point out that you see the variable costs and then your margins, okay, after your marketing. And this is just displaying the information in a different way. It's going to be useful for you to look at and explore. Remember to check your courier information. Here you have a high market and it points at Atom as your high market. Here you have your performance market and it says that's aft, and here's your size market and that's agape. Don't forget to look in the right markets for the right products and refer to what they sold for last year, and then look at where they're going this year and try to keep that in mind while you're making these decisions. Now let's move on to production. Okay, I wanted to briefly point out one thing real quick before I actually get into Mercantaria, which is the production for Acre. Please note, Paul, that the second production percentage from the previous year, the year before, like year 0, basically before our practice rounds, has this set up at a 30% overtime rate. We don't have to do a 30% overtime rate. We could go down and say, for instance, if I mark that down to 15, 20, and you can sample this out because we really would prefer not to have to run overtime, right? And see, if I move that down, it goes down to 8.6%. And then let me try moving that to 1420. See what happens there. It might be too low there. Okay, 1 point. Alright, let's try 1400 then. See what happens. Alright, so I'm gonna say that, there we go. So 1395, we get a 0% overtime rate, and it also bumps the contribution margin up because we're not using overtime dollars anymore. That means this product, Acre, becomes more useful. So this is actually something kind of useful for both our people working on marketing and production. That is something to keep in mind, that by reducing the overtime portion, getting rid of that, you boost the contribution margin of this product because it is now cheaper to make because you're not having to spend overtime dollars to do it. So 1381 we can produce well. So make sure when you're entering in your marketing decisions over here, make sure you put your forecast in for each product. But I just wanted to point that one out because it is kind of sneaky that they had that already set up with overtime value, and it doesn't need to stay there. All right, so let's talk about production. And production is mostly going to be how much are we going to try to produce. We want to try to keep our overtime costs at zero. If we're going to go into overtime, we need to have a good reason to be doing it. We want to keep our contribution margins high, and we want to be increasing our plant capacity so that we don't have to do overtime. So we want to also reduce labor costs so that if we have overtime, so to speak, that it's highly automated. Right now, one of the reasons the labor costs for these three is so high is because they have the three lowest automation ratings. Now you see here in the tooltip, automation ratings, anything changed in automation rating or buy and sell capacity will be counted next year. None of this stuff is going to be applicable for this year's decisions. Decisions for year one are going to be limited to these values here. When you're making changes for year two. So this will be what we see when we open it up for next year. If you wanted to boost up and look at the contribution margins of these products, we have this one is our most contributing product right here. And yet it is one of the three automations with one of the very high labor costs. So if we can move this, if we can say, for instance, let me just jump out. Here's your budget, right? This you're working with your budget. So let me try to, let me try to change these to 5s. And let's say that that was just what we wanted to try to do. Let's see how much that's going to cost to do. And so I changed it to 5s, and it fills in some investment amounts, and it says that's going to cost 24 of our 32 to boost the automation. Now boosting the automation is going to reduce the amount of people that we need to work. You can see that this new change here reduces the amount of people that we need to work the automation by 60 people. So that's excellent in terms of how much labor costs on average per unit. So you also want to work on increasing capacity. Alright, for instance, again with Atom, it is one of it is currently the highest contributing product, and yet it only has a 900 unit production capacity. So for that, if we wanted to try to buy 200 units of production capacity, for example, and you could buy more or less, let's see what the cost would be for that. And you can see that actually I forgot what it was before. Let me take it back to 0 and then I'll look at it again. Okay, so that's 29.2 and 24. So it cost 5,200 to add 200 capacity. Alright, so your chances are pretty good that you're not going to be able to do much more than that for each of them. Now, something else to consider while you're looking at production is the amounts that you were selling before. Okay, so take a look back here